CSTF for the UK team and team in France. And I just want to spend a couple of time discussing commodity and structured trade finance and its relevance to the mining sector. I think the first thing is to say, let's have a quick look at commodities in general and working capital. Okay, so here we can see the value chain that we see in commodities. So effectively we have producers, traders, and their destination market, where the actual commodities are going. Obviously a lot of you will be aware that over the past 10, 15 years, the consumption and the urbanization of China has played a major role in commodities prices and commodity development. I want to concentrate first on pre-export financing and prepayment financing. I don't know if you can see it on the board. That's the first from the producer's angle as to how they're financing their mines and their production aspects. We can go through some of the structures that we see relevant in the market today. So why is CSTF relevant to mining? First of all, commodity and structured trade finance techniques are not new. They've been around since the mid-1980s, probably as a result of sovereign crises and an ability to leverage against future commodity export flows. And if we discuss some of these aspects and how relevant they are perhaps to Armenia, it would be an interesting discussion. So generally they started in the late 80s, developed in the 1990s, primarily in sub-Saharan Africa, where you have large economies, large natural resource ore deposits or oil and gas fields, but you generally have a lower or a reduced credit environment in order to finance this project. So you basically look at how a banker looks at those financing. If you go across this is where globalization comes in. We're talking about Brazil and Armenia. Brazil has a long history of financing its hard currency prepayments. So this is what they call prepagamentos. Currency coming into the country, again, to be repaid by the future delivery of commodities into the international market. They have had these type of structures since the 1960s, primarily to bring hard dollars into the country to maintain the strength of their local currency, the real. The market's expanded globally since then into various geographies, with the natural resource and extractive industries being one of the most prevalent of these techniques. So the business, from a banking perspective, we focus on several key aspects. What we refer to as performance risk, which is effectively a banker's view that the mining asset will continue to produce its commodity for an ongoing basis in terms of the repayment of the financing. The off-taker risk, which is effectively the buyer who is physically purchasing the commodities or who the mine is selling to. And payment offshore, which can mitigate, if relevant, country risk and other factors. So what exactly is it, to sum up in a definition? There are many definitions. This is mine. It's the financing of counterparts based on a banker's assessment of that counterpart's ability to reliably produce a specific commodity for which there is a high export rationale, for delivery to a creditworthy buyer. Payment of that commodity is made offshore to repay the financing bank. It's a big long statement. But if you look at it from a perspective, what does that mean? So if the mine is a strong mine and will continue to produce its commodity, then you're comfortable that there is a performance risk, that the mine will continue to produce. If you look at what does a high export rationale mean? If you're producing, say, copper cathodes, or you're producing iron ore, what is the potential to consume that commodity in country? So if you don't have a large steel capacity production, you don't have a large manufacturing basis to produce to consume the copper, then the iron ore or the copper must be destined for an export market. Otherwise, you're producing material that has no use in the country. So if there's a high export factor, that is attractive from a banker's perspective because that commodity must be exported. And if it's exported as it's a commodity, the chances are it will be paid for or purchased for in US dollars or euros or other hard currency, or maybe in the future, which is interesting to HSBC, is RMB, the Chinese currency. So what does it achieve? From the client's perspective, you get access to international bank liquidity beyond that offered by the local market. So if you have an economy that is growing or is developing, the ability of your local banks to finance significant amounts of capital is generally constrained by the size of those local banks' balance sheet and how they can raise those that amount of funding. By using commodity and structured trade finance, you can access the international bank liquidity from international banks that have larger balance sheets and wish to deploy capital into developing markets and their natural resource sectors. Potentially low funding costs. If anyone is looking at interest rates, maybe they will go up, maybe they will stay the same, but they're generally base rate for US dollar, sterling, major currencies are extremely low. You see bespoke solution and structuring techniques. So it's not here is your solution, here is your product. It is more banker, commodity and structured trade finance banker, seeks to build financing around the ability of the mine and how the mine operates, what its production levels are, how it delivers its commodity to its clients, who the buyers are.